Welcome to Mad Money. Welcome to Cramer. My friends, I'm just trying to make a little bit of money here. My job is not just to entertain, but to put it in context, to, you know what, educate you. So call me at 1-800-743-CNBC. Tweet me at Jim Cramer. The beginning of the year, a wildly emotional time. What do you got? You got the ride 'em cowboy crowd that likes to stick with the stocks with the best momentum from the previous year. Then there's the hope-springing eternal contingent that goes for the underperformers, stocks crushed by tax loss selling, by the way. And you've got people who buy the mistaken stocks, perhaps the ones that should never have gone down to begin with. All these buyers are coalescing right now to give you a strong tape with the Dow Jones Industrial Average going up 485 points today, S&P gaining 0.62%, and the Nasdaq climbing 0.65%. Buy! Right now, the ride 'em cowboy folks are totally jonesing for anything that can help you store data. The AI revolution has caused an explosion of data, and the storage industry just wasn't ready. It couldn't handle it. When you see stocks like Western Digital up almost 16%, SanDisk soaring 28%, Seagate climbing 14%, Micron jumping 10% in one session, you know this is a quintessential momentum buying coupled with short sellers panicking and trying to cover their short positions ahead of these buyers. Why do these stocks keep running? Because there is a shortage of machines that make memory chips for them. That's why you see the semiconductor capital equipment makers like Lam Research, Applied Materials, KLA rallying too. When I say this is emotional buying, I mean it can get to be irrational as the greater fool theory takes over. But I've always known that this could happen. Do you know that more than 30 years ago, when I was a hedge fund manager, I bought 5% of Western Digital, betting this kind of explosion could be on the horizon. I was diligent. I called around, checked pricing constantly, didn't miss a data point. But I failed to keep track of how many components in the industry that so many companies were spending on capital equipment that would let them manufacture more hard drives. Turns out that as supply tightened and prices went up, the hard drive companies spent a fortune, built more capacity, and then massively overproduced, flooding the world with excess hard drives. I didn't see the deluge coming. So once all these machines started spitting out all these drives, pricing plummeted, and I took a bath in Western Digi. Right now, though, the demand is so voracious that even as Lam, KLA, and Applied Materials are running flat out producing these machines, Western Digi, Seagate, and SanDisk, and Micron, well, it's not enough. They can't get enough. Demand can't be sated. Pricing's going up so much that their non-data center customers, mainly PC makers, are getting killed. It's a nightmare for the users, but it's nirvana for the shareholders, at least until the capital equipment makers catch up. And they do always catch up, but the short sellers, they haven't caught up fast enough. Short sellers know this, but they have a bad sense of timing, which is why they keep going in to challenge these stocks, and they keep getting their heads handed to them. The ride 'em cowboys are winning so far in 2026. These stocks are up so much that some fund managers have already made their years, and it's only the third day of 2026 trading.
How's pleasure?
It's not just the storage companies. The banks have come in with a full head of steam. They're simply picking up where they left off in 2025. The loosening of regulations coupled with the rise of M&A, equity issuance, can explain these remarkable runs. Here I'm thinking about the gains in Goldman Sachs, Capital One, Citigroup. I know they seem excessive, but you have to recognize that the financials have been punished for almost 2 decades. Before the Great Recession, lots of banks had price earnings multiples that were actually like a lot of other stocks, the S&P 500. But valuations collapsed as bank failures dominated the headlines, and then securities regulations tamped down the growth of the group to prevent another financial crisis. That's all changing now. So the banks are seeing the price earnings multiples expand. They still have a lot to grow before they become fully valued. Then there are the hope spring eternal buyers. I see a bunch of these stories, and I'm involved in some of them for the Charitable Trust. Stocks like Nike, like Starbucks, which have seen their share prices just obliterated by the poor performance of previous CEOs. I see green shoots in both these companies, and their strength, I've got to tell you, the strength this year so far reflects a real rebound. The 3 insider buyers of Nike, the CEO, a board member who was the former CEO of Intel, and, of course, Tim Cook, CEO of Apple, all signal that the business is indeed turning. Remember, insiders might sell for a lot of reasons, but they only buy because they think a stock's headed higher. Longer term, they can't flip. As for Starbucks, I think this is the year it comes back. But I have to tell you that it's been a tough run for CEO Brian Niccol, late of Chipotle, as it seems like the Seattle-based coffee chain was far more broken than anyone realized. Lots of poorly performing stores. Many of them are being closed. Big execution issues. Those are being fixed. Miserable throughput. That's already been fixed. I think everything's changing for the better. I'm also seeing rebounds in some underperforming industrial stocks that are not part of the data center business, which therefore made them uninvestable in 2025. These were beaten down because they lacked AI-related momentum. I'm talking about a Honeywell or Dover, two conglomerates, with one, Honeywell, currently undergoing a breakup. They've been hapless performers, but hope springs eternal even for me that they'll get these right this time. That's why we're approaching that positive attitude for the Chapel Trust. Finally, there are stocks that never should have underperformed to begin with. Now, these were cases of what I call mistaken identity. Chief among them is the stock of Amazon. This hyperscaler, one of the greatest companies in history, saw its stock pull up barely more than 5%. In a year where the S&P was up 16%, NASDAQ rallied 20%. When last Amazon reported, the stock soared from $222 to $254. Oh, it was a huge move. But it then proceeded to give up the entire gain and became a laggard again. The stock convinced people, the stock, okay, not the company, the stock's decline convinced people there must be something terribly wrong with the business. But it sure wasn't from its incredibly lucrative Amazon Web Services business, which has started to reaccelerate. It wasn't from its retail business, which was amazingly strong. The advertising business, total gravy, exceptional. So what went wrong? I've looked, and I reread the conference call from the last quarter, saw all the contemporaneous research notes before I came out today. And I am telling you, there was absolutely nothing wrong. Nothing. Except perhaps an expectation on the part of some analysts that retail sales might be weak, which they weren't. So now Amazon's playing catch-up based on the mistaken identity that it was a loser. It never was. Of the three categories, you should know I prefer the mistaken identity investments to the momentum stocks and the resuscitation stocks. But this market likes a wet January, not a dry one. And I expect the emotional trading could last a little bit more as the year just started. Here's the bottom line. We've seen these trends last as long as 10 trading days into the new year before we've gotten even a sharp correction. It wouldn't surprise me if that happens again. So if you have big gains, say in the Seagate or Western Digital or SanDisk, please don't be so greedy. It's time to ring the register tomorrow morning on part of your position. Meanwhile, I say hold on to the turnaround stocks and buy the mistaken identities because they're the ones that should keep running as we go further into the new year. Let's take calls. Let's go to Ian in North Carolina. Ian.
Jimbo, how we feeling? Happy New Year.
Real good. Happy New Year to you, Ian. What's going on?
Nothing. My Hoosiers are playing in the Peach Bowl. Tough to beat it.
No, it is. It's really fantastic. And congratulations to Mark Cuban, who was with us as a guest when we went to Indiana for such a great school tour. How can I help you now?
Yes, sir. Well, Cheniere Energy has been sliding for about a year now. Is it a good time to pick up some, or will the slide continue?
Well, you know, I've got to tell you, it's not my favorite right here. I prefer, as I say in How to Make Money in Any Market, I much more prefer the higher yielding ones. I think One Oak is better, and I really like Enterprise Product Partners here. I think those are better, more growth, better yield. Let's go to Preston in Maryland. Preston.
Hey, Jim. Happy New Year.
Same to you, Preston. How can I help?
Well, at your recommendation a couple of years ago, I took a small position in a company which is now down over 50%. So I'm wondering if I should hold it, sell it, or buy more. And if sell it, do you have any good recommendation? My company is Sweet Green.
Okay, Sweet Green has decent revenue growth, but it just can't seem to turn it into a profit. They've got to start making money, I got to tell you, or else I think it is going to go even lower. The one that we like is very hard group, just so you know. But we like Texas Roadhouse, which has been coming back big. And if we get any break in cattle, cattle's going up. That thing could go to 200. It's 177 up $3.64 today, and I like that one much more than one you're in. All right, please, don't be greedy. This is a good time to ring the register on anything that has shot up gigantically, particularly the storage plays, and maybe put that money to work in a stock that could make a big turnaround this year. On Mad Money tonight, as we step into a new year, I'm giving you my review of the Magnificent Seven stocks, starting with the top two performers that I think can keep tracking higher. Then I'm taking a look at the other five, which actually underperform the broader market. Are they still winners, or is it time to cut them loose? I'm going to reveal my take. And with aerospace likely becoming a more dominant theme this year, I'm sitting down with the CEO of full-service aviation player AAR, which reported this evening, to find out more about the company's trajectory. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.